There are people who lost all their retirement money in the stock market. There are people who keep losing fortunes after fortunes. And there are people who have made millions and some even made billions of dollars in the stock market. Who are they? We are going to find out right after this. Hey guys, this is Sang Win. If you like my video, be sure to subscribe to my channel and hit the bell to get notified of new videos. And feel free to share this video with families and your friends. Okay, let's get right to it. So, what are the type of investors, traders, and gamblers are in the stock market? The first type is investors, short-term and long-term. Short-term investors usually have stop loss for price in place, meaning that when a stock loses a certain amount of money and reaches a certain amount of price, they get out. These short-term investors don't want to lose more money and don't want to get their money stuck in a losing position. When they get out, they can join other profitable stocks or opportunities when the time show up. Short-term investors usually invest on their own. They like to manage their own money. They lean toward fundamentals before buying and selling. The long-term investors normally don't have a price stop loss. They have what is called a time target. Some people say, hey, I want to invest 10 years so that when I get to retirement, I have a certain amount of time and I have a certain amount of money. That is a time target. Most of these investors invest in 401ks, IRAs, mutual funds, hedge funds if they are rich. Okay. The typical long-term investors, they are willing to hold their money through the downturn of the market. They are not concerned with the wild swing of the market. They are willing to ride it out. The thing is, they will be missing out on opportunities because their money is stuck in a losing position. But they are faithful to their investments. Therefore, they are not going to jump ship easily. These long-term investors lean toward fundamental research before buying and selling. Many of these long-term investors, they like to leave money for other people to invest for them, such as mutual funds, life insurance company, banks, because often they don't know how to do the research themselves, or they don't want to, or they just don't have the time. The typical average return for investors is this. The average yield return after 10 years is between 8 to 10% for conservative investors, 10 to 15% for moderately aggressive investors, 20 to 25% for aggressive to highly aggressive investors. Here is what it means. If someone has $10,000 and invested for 10 years with an 8% return, they will have $21,589. If they average a 10% per year return, they would have $25,900. Now, on the aggressive side, if they can average a 20% return, oops, I made a mistake. Hold on. This one should be 15 right here. Okay, 15. So if they average 15% return, they have $40,455. And if they are on the aggressive side and can average a 20% return, they would have $61,917. As you can see, the more aggressive someone is, normally now, they would often get higher return. Those are investors, short-term and long-term. As you can see from this picture right here, these are what the typical investors invest their money in. Some like to invest and manage their own money. Okay, next, we are going to move to the traders. Now, we're going to go talk about the newbie trader first. Newbie traders typically lose all their money in about 6 months. The statistic is this: it is 90-96, meaning 90% of all the new traders lose 90% of all their money in 6 months. Now, that statistic has been in existence for a very long time, since the stock market began. Now, with the recent easy access to the internet and brokerage app, the statistic is this: it is 90-90-90. Here's what it means: 90% of all new traders lose 90% of their trading capital in about 90 days. Now, why is that? It is because new traders often have high expectation without solid foundation of knowledge. They buy on quick research, hunches, feelings, rumors, or tips from friends or group. They love to win big money fast and are willing to take the blind spot big risk without truly understanding the risks. They often don't have a trading plan and love the action. Therefore, the statistic is sad, but 90% of all newbie traders lose 90% of all their money in about 90 days, and in about 6 months, they will lose all their money. Now, average yearly return for new traders is actually negative because most of them quit. If they do come back, they continue to lose money until they learn and become professionals. And that learning curve is usually 4 to 5 years of painful lessons, many mistakes, and loss of hard-earned money. Now, some new traders, if they are lucky, they can find a mentor that can help them. A mentor can help them avoid many mistakes, help them make money faster. But the new traders will continue to make mistakes because of internal habits, which all of us have. Once the new trader fixed those bad habits, they can succeed unbelievably. Now that is a new traders. Okay, the next group is the pro traders. The pro traders, they have solid understanding of the stock market. They often have a trading plan and specialize in certain style of trading. And they have rules that keep them out of trouble and put them on the profitable side. Most of them, true pros, have rules. Now, anyone who claims to be pros, yet they don't have rules, that help them, manage the risk, help them take advantage of profitable opportunities, we call those fake gurus. These people have learned so much, the pros, the real pros, have learned so much and have thrown away what is not part of their plan or part of their vision. Meaning, they don't try to master every style of trading or every type of trading, but just focus on what best fit them, and they master it. And they make good amount of money. Normally for the pros, their wins are bigger than their losses. Their good winning percentage is at least 40%, but when they win 2, 3, 4 times bigger than their loss. Now, some of the very good pros, they would have winning percentage of 50%. And some extraordinary traders would have 60% winning percentage. And on some rare occasion, you will find a successful professional trader who has a 70% winning ratio. Wow, their wins are bigger than the losses, meaning the amount of money. Okay, now the pro life. After the learning curve, you know, usually 5 to 7 years of learning on their own. They have their own plan, they have their own vision, and can often turn a small amount of money into millions of dollars in just a few years. And then they make millions of dollars every year for the rest of their life. We all know and heard a successful story like this because I'm sure there are lots of them on YouTube, on Fortune magazine, on Business Insiders, and Forbes magazine about traders who are successful. Those are the professional traders. Here's what the traders typically look like. They have multi-computers. Sometimes they trade on the stock exchange, and this is just some pictures of the traders, pros hopefully, that trades on the floors. Now, the next one, we are going to go with the gamblers. The gamblers, now they are the fun, they are the life of the party. These are dream chasers. There are many gamblers in the stock market who think they are investors or traders. Let me break it down for you. Okay, gamblers, they love to go all in. Just like playing poker, They think they have a good end, so they go all in. Now, they are there for the action because it is a rush and it is a high. Because the stock market is a very emotional place and they often draw a lot of gamblers toward it. And the emotions are addicting to the gamblers. They will often buy and sell on rumors, friends tips, some news without any kind of plan. They have no plan, no true knowledge, and they just want big money and fast money. Some gamblers, or business owners with lots of money already, they just want to strike it big in the stock market, and often they end up losing. Now, some gamblers lose multiple times, but they still come back because they have other sources of money. As just like I said earlier, some gamblers are or business owners, so they have an income that fund their gambling in the stock market. Some millionaires are gamblers and have lost millions of dollars, not once, but multiple times. I am sure you have heard all these kind of stories before. Okay, gamblers, they will never listen to true advice until they have lost so much that it is painful to them. Now, some gamblers lost so often and for so long, they actually become desensitized to the emotion of painful loss and can often recover quickly and they will come back. Now, for some gamblers, they might get kissed by Lady Luck and will hit big and make a ton of money in a very short amount of time. And often they will blow all the money on a spending spree like Las Vegas shopping or all kind of outrageous spending. Now, when they do come back to the stock market, they think they're going to hit big again. More often than not, they will lose all of whatever is left while chasing the next big winner just to find out that Lady Luck is not on their side. There will always be gamblers in the stock market because the stock market is the ultimate feel to make money and lose money. That is the three types of investors, traders, and gamblers that are in the stock market. Hey, that is the end of my video. Thanks for watching, and remember to subscribe and share this video with friends and family. Everyone likes to know exactly what is going on and have more information about it. Until next time, until my next video, have a good one.